Good afternoon, ladies and gentlemen. While we wait for the panel discussion to commence, may I draw your attention to the screen where we will be playing the video of the Asia panel launch that took place in June this year.
Infrastructure is foundational to social and economic development. With COVID-19, there is an increasing need for sustainable and resilient infrastructure to support public health and economic recovery. Singapore is a key infrastructure hub in Asia. It's also ASEAN's largest green finance market and home to a rich ecosystem of infrastructure players and professional service providers. With this strong ecosystem, Singapore hopes to accelerate the development of sustainable infrastructure in Asia through the sharing of latest trends, ideas, and best practices.
There have been very significant global challenges affecting the future of infrastructure, and we need to respond to these challenges by designing, constructing, operating, and maintaining new and existing infrastructure to serve the needs of society and improve quality of life for all of our citizens.
Today's sustainability challenge is about net zero challenge, which means we are going to rely on wind, solar, hydrogen, and also natural-based carbon. So that's the foundation, which means you are going to have a much better forecasting on the global weather pattern, advanced IoT and AI and big data technology to harness such a complicated system, which help us to achieve a sustainable world.
Infrastructure will be a greater focus on technology adoption, such as AI and robotics, the use of drones to improve safety and inspections, digital twins, building information modeling and 3D printing. And of course, there will be a growing need for very secure, resilient, cloud-based technologies and connective infrastructure.
We should certainly embrace technology. And for example, cloud data environment platform development computing will enable us to roll out more effective offerings to developers and infrastructure investors without them having to build out at enormous expense and cost to the environment in terms of, for example, the use of energy.
I had a hand in developing membrane technology, and the beauty of membrane technology is that it can produce water efficiently and reliably. Evolution of technology will probably drive us toward more localized ways of living, better digital infrastructure, different kind of transportation with no pollution, more resources produced locally. That will be a good thing for the environment, also good for living in cities.
Sustainability used to be a nice to have. Now, sustainability is absolutely required. Infrastructure investment typically creates jobs. So infrastructure development itself not only creating the additional infra such as power to home and so forth, but improve the economical situation of communities and also the country.
There are large regions of the world that are challenged with economic growth. When you evaluate opportunities for growth and driving economic growth going forward, infrastructure is an important component to the integration of the global community. And so a well-integrated world based upon common standards with infrastructure would enhance the quality for all of our lives. This is not a matter of global competition. This is a matter of global partnership to make this a better world for all.
A future with sustainable infrastructure is one which provides for the long-term economic, financial, social, environmental well-being across generations. It creates a conducive environment for all to live, work and play, and it helps societies stay resilient to challenges or disruptions that may come their way. I look forward to the inaugural panel meeting, Asia Panel, Towards a Sustainable Future.
Ladies and gentlemen, welcome, and thank you for joining us in the Asia Panel public discussion on sustainable investment financing, co-organized by ASEAN Plus 3 Working Group 1, Global Infrastructure Hub, and Infrastructure Asia. To start the program, I would like to introduce the moderator, Mr. Levan Thiru, Deputy Executive Director from Infrastructure Asia. Levan, please.
Thank you, Nessie. Ladies and gentlemen, good afternoon, and thank you for joining us. With me on stage today is Ms. Keiko Honda, Adjunct Senior Research Scholar and Adjunct Professor from Columbia University. Today's discussion on sustainable investment and financing, the third in a series of Asia Panel public discussions. Yesterday, we had insightful sharing on the trends in infrastructure for the future, as well as some of the role that technology might play. Today, we seek to address the most important topic: how do we finance all of this? So we will be talking about how can we accelerate the growth of private capital in sustainable investments, how standards and taxonomies might be able to help us, and we look at some real-life examples on sustainable solutions that have been implemented in the region. To start off this afternoon's program, it is my pleasure to invite Mr. Gautam Mukherjee, Chief Risk Officer, HSBC Singapore, to deliver his welcome address. Mr. Mukherjee, please.
Thank you. Good afternoon to all. Thank you for joining us for the discussion today, and thank you for inviting me for this session this afternoon. The rapid growth in Asia over the last decade has been supported by significant investments in infrastructure. However, we all know a large part of this has been carbon intensive. It is estimated that Asia contributed roughly 87% of global emissions growth since 1990. The key to world transition to net zero, therefore, is Asia. In order to achieve alignment with Paris Agreement, significant amount of capital will be needed to develop sustainable infrastructure in Asia. Closing this financing gap would require us to establish consistent standards for sustainable projects, as well as to create innovative solutions that would facilitate investment decisions and attract international financing. Let me talk about taxonomies first. In Asia, we need a taxonomy that supports transition activities while achieving compatibility with existing high-quality international taxonomies. It is well acknowledged that we are unlikely to have a single global taxonomy, so efforts should focus on ensuring that taxonomies within Asia are interoperable and comparable to facilitate international flow of capital to the region, while taking into account the unique local context. In March of this year, the ASEAN countries formed the ASEAN Taxonomy Board to develop a taxonomy for the region that would accommodate different level of economic development. An industry advisory panel, or an IAP, was formed by the ASEAN regulators to provide industry inputs around taxonomies, disclosures, supply and demand, and transition standards. HSBC is a member of the IAP and chairs the transition group on transition standards that made various recommendations to the regulators, including refreshing their commitment to a defined end goal and having credible transition pathways for hard-to-abate sectors, in particular the energy sector. The Taxonomy Board is likely to come out with an announcement soon on a multi-tier architecture, including a foundation framework and a plus standard. The plus standard will set out data-backed thresholds for each activities, starting with less ambition thresholds to facilitate early adoption and leading up to more ambition thresholds that reference science-based pathways. Closer to home in Singapore, the Green Finance Industry Task Force, or GFIT for short, was convened by MAS in 2019 and chaired by HSBC, aims to accelerate the green ecosystem year. One of the key areas for GFIT is developing a taxonomy for Singapore-based financial institutions. The Singapore taxonomy adopts a traffic light system aiming to help market participants to identify activities that are green, yellow or in transition, and red, with the intent of reaching net zero as early as possible. This has gone through a public consultation process, and work is currently underway to finalize this, including calibration of pathways for hard-to-abate sectors. The Singapore taxonomy is expected to dovetail with the Plus standard in the ASEAN taxonomy and use a science-based glide path approach compatible to international standards. Let me move on to the second area, energy transition. Energy transition is very critical for the region, with a big opportunity to reduce high emissions in the sector and continue to support economic growth. Singapore, as a financing hub for the region, will play a key role in scaling sustainable finance and providing access to international finance to aid this transition. It's been working on a number of initiatives in this area. In May, GFIT published a white paper identifying solutions for scaling green finance in 5 sectors, including the infrastructure sector. Solutions highlighted specifically for the sector included promoting issuance of project bonds and developing securitization of sustainable infrastructure loans. Within HSBC, we also recognize the need for consistent standards and innovative solutions to catalyze financing for the infrastructure sector. We are leading the FAST Infra, short for Finance to Accelerate the Sustainable Transition Infrastructure initiative, along with IFC, OECD, and World Bank. At COP26, Sustainable Infrastructure label was launched as a globally consistent labeling system for such projects. The label will help attract institutional investors and transform sustainable infrastructure into mainstream liquid asset class, and is endorsed by leading coalitions such as the Glasgow Financial Alliance for Net Zero, or GFANZ. HSBC also, in partnership with Temasek, has recently launched a debt financing platform dedicated to catalyze capital flow to marginally bankable but worthy sustainable infrastructure projects with an initial focus on Southeast Asia. The ambition is to build a pipeline of projects to scale, with the platform targeting $1 billion of loans over the next 5 years to support region's sustainable infrastructure sector. In conclusion, we are seeing positive development in terms of actual deployment of capital for sustainable infrastructure, as well as very strong all-round efforts to support the transition. Clearly, more needs to be done in this journey. A successful transition will require collective efforts across governments, businesses, and industry leaders. I welcome you all once again and look forward to hearing fresh ideas during the discussions today. Thank you.
Thank you, Mr. Mukherjee. To set the stage for the discussion today, I'm pleased to be joined virtually by Mr. Henry Blas, Chief Content Officer at the Global Infrastructure Hub, and members of the Asia panel, Mr. Scott Minard, Chairman and Global CIO, Guggenheim Partners, and Ms. Keiko Honda, who is with us in person. A warm welcome, Henry, Scott, and Keiko. Henry, can I ask you to kick off the session by sharing some of your insights?
Thank you, Lavan, and very pleased to be with everyone virtually today. So I'm going to go very, very quickly because I think the first speaker already covered quite a bit on taxonomies, but just wanted to give, I guess, a global overview as to what's going on when it comes to infrastructure and sustainable infrastructure in particular. So next slide, please. Next slide. Yeah. So first, very quickly about the Global Infrastructure Hub. So we are the dedicated infrastructure entity of the G20, which means that a lot of what we do is in support and in collaboration with the G20, and we support them on their priorities around sustainable, resilient, and inclusive infrastructure. Next slide. So I think, I mean, obviously with COP26, everyone has seen sort of countries, and actually that graph is probably need to be updated now. A lot of countries are moving towards carbon neutrality targets, and they're increasingly looking at broad regulations. So we've seen a lot of countries looking more closely at TCFD, in some cases, making them mandatory, like in UK and a few other countries in Europe. We've also seen that a lot of taxonomies emerging, and it's good to see that in Southeast Asia and ASEAN is also looking at similar taxonomies. The European one is probably the oldest one, and is influencing quite a bit all the other one globally. Next slide. So when it comes to the G20, one of the key initiatives this year that was launched by the Italy presidency and very successful was creating what was called the Sustainable Finance Working Group. It's a working group. I think is more to highlight as co-chaired by the US and China, and so really sort of has got a lot of traction globally. And they really look at how we could overall sort of find a better alignment between taxonomies. I don't think here we're talking about having a globally shared taxonomies. I think that is each region will have their own. But what emerged out of that is the creation of the International Sustainability Standards Board, which will play a key role in harmonizing some of those taxonomies, so that we don't have issues between different regions, and also we sort of come to an end of greenwashing in general. The initial focus will be on climate change, with the idea will be to sort of widen that to other priorities. Next slide. When it comes to more specifically to infrastructure, there's a couple of interesting things that sort of appearing in Europe. What we've seen is the creation of what's called the infrastructure supporting factors, and it's the regulators actually making infrastructure as a sort of a specific asset class with sort of lower regulatory capital requirements. And we also see the emergence of, at the moment, was just a guidance on climate proofing of infrastructure, probably sort of more regulations coming down the line, and potentially again some regulatory bonuses, I guess, for sustainable infrastructure. Next slide. All right, so that's when it comes to the regulation. When it comes to the corporate side, what we've seen is that infrastructure investors in general are way more advanced than other corporates. So in that graph, you can see the average ESG rating at the corporate level. And that's the middle one. And you can see that on average, infrastructure investors are way higher. And when you look at it from a weighted average, because it's a very concentrated market, you can see that it's really, really well above average. So overall, infrastructure investors have always been at the forefront of ESG adoption. Next slide. And you can see in Asia, obviously, that number has sort of gone up very significantly. And when it comes to between the E and the S and the G, I guess, environment is really the one sort of very different. So here you can see the difference between the average corporate. Environment overall has always been something that infrastructure investors are really focused on. But in the last 5 years, you've seen a massive increase, especially in Asia, where, I mean, you can see that the line speaks for itself. Asian investors in general, investors in Asia, sorry, it's not Asian investors, it's investors in Asia are more and more concerned about environment. Next slide. All right, so if I was to summarize and maybe open up for discussion after that, when it comes to sustainable infrastructure as an asset class, what we're seeing is the emergence of standards specifically for sustainable infrastructure. And I'm glad we're going to hear more about Fast Infra. HSBC already sort of mentioned it, but I think we have some speaker from Fast Infra as well. I really believe that this is that type of label will really help leverage some investors into Asia for sustainable infrastructure. We think that more generally, infrastructure asset ratings are to become the norm. If you take GRESB, which is one of the leading one, you can see the number of assets that are being rated is really increasing fast. And when you look at the numbers in Asia, you can see there's a lot of room to play, a lot of room to grow. And so we expect that there's going to be a lot of pressure going forward for asset owners and sort of sponsors to actually get their asset rated. The other aspect of this transition, which was mentioned by the previous speaker, and we can see that if you look at the carbon disclosure project and number of corporates that's sort of looking at sustainable, science-based targets, you can see that at the moment it's already 25%. It's going very fast. And again, by the end of COP26, we may have even higher numbers. So I think transition and ratings are not only here to stay, but they're really going to increase going forward. Next slide. So overall, the key focus, I think the first one is on definition. So we already talked about it. I think those taxonomies and label are sort of emerging, and I think soon enough, hopefully, we'll get more clarity. The two things are probably missing. The first one is the local capacity. Obviously, the one it's a bit difficult to build capacity because there's still a lot of moving definitions, but that's going to be critical in order to prepare those projects and to attract investors from other regions with the right sort of the right type of assets, the right type of opportunities. And the third one is obviously the pipeline itself. The challenge at the moment, I think, if you look, I mean, we'll look at the numbers later on, but renewables is kind of like a relatively easy one. I think most investors are happy and sort of confident that it won't be a transition risk. But when it comes to all the sectors in infrastructure, there's still a lot of question as to whether the asset will not become stranded even in 1 decade. And so that creates a lot of uncertainty around the potential pipeline around sustainable infrastructure. Thank you.
Thank you, Henry, for the sharing. Scott, could you help set the context from the perspective of an investor involved in investing in sustainable infrastructure?
Sure. I think that one of the issues we face with sustainable infrastructure is the tendency to bucket everything into one class. And, for certain, there are many things around climate, which I think we all can agree upon that would be relatively simple to identify as sustainable infrastructure, whether that be solar or wind or any number of other things in terms of energy. But there's also an issue in infrastructure around the needs of developing countries, especially in the area of things like highways and ports, and a lot of things that the developed nations actually take for granted. And so there is a cost here to the environment in the fabrication of things like cement and how much is being, how much carbon emissions occurring in that process. It's very difficult to stand in the way of these nations who want to take advantage of advancing their economies and to tell them that these activities are damaging to the environment and therefore in some way have to be restricted or restrained. So when I look at the taxonomy issue, I consider the fact that there are a number of things that are important to consider at the get-go and are not easily just put into one big class. And let me give you some examples. The constituents. Is this beneficial to the constituents both economically and environmentally and socially? Or is this are the policies that are being put in place hindering the things that would advance their quality of living? Also, criteria, consistent criteria around this that can be applied across the board. And then coordination. There's a lot of issues in the area of economic development which have competitive natures to them in terms of regional or global competition. And so I think there's a need to understand which projects are redundant and which projects are really necessary and productive. I can go on with many of the things that are on this sort of a list, but the one thing that I point to all the time, and certainly the Global Infrastructure Hub is a great place to address it, is international coordination. There's a lot of infrastructure which needs to be built that cannot be done without multinational interest. And one of my favorite subjects is the effects of climate change on the Arctic. There is a vast growth of shipping occurring in the Arctic Ocean today, but there is virtually no international cooperation on how to regulate it, how to build the infrastructure, and to whose benefit that accrues. The other side of it is that along with that challenge that we face is the need to address black carbon. Shipping is notorious for producing lots of black carbon. Black carbon in the Arctic would be disastrous in terms of accelerating the ice decay. And so, what are the global standards for shipping? And so it's very difficult to be an investor who wants to act responsibly and not have a framework or a place to go to work on a framework where we can actually get very granular and say, what is the objective in 10 years and 20 years for an area like shipping? And what is good sustainable investing from the standpoint of building ships and ports and other infrastructure that'll be necessary to continue the expansion of global trade and raise living standards around the world.
Thank you for setting the context along the 3 C's that you mentioned: constituents, criteria, and coordination. That provides us quite a good framework for how we think about today's session. Keiko, based on what Henry and Scott have shared, could you share some additional insights?
Sure. First of all, thank you, Levin, for having me today, and good afternoon to everybody. Before I answer to the questions, please allow me to share 2 forces at work in investing infrastructure in Asia that I observed. The first one is many institutional long-term investors, such as pension funds, are increasing their investment in infrastructure, including to improve the diversity of the portfolio. Second forces of work is the increase of ESG investing, as I think everybody just mentioned, including as Minister Indranee Rajah mentioned yesterday. Approximately 60% of professionally managed assets in Australia, New Zealand, and Canada are now under ESG investing. 50% in Europe, 1/3 in the US, and 25% in Japan. We used to discuss whether ESG investing is meeting fiduciary duty for pension fund or not. As a matter of fact, that was very heated discussions in the United States where I live right now during the previous administration. But now the consensus is ESG investing is a part of fiduciary duty. So it is highly likely that more money will also flow into ESG investing. So new investors, including institutional investors, are now considering investing in infrastructure in Asia. Although I've been kind of saying before in a video, what we are missing in infrastructure investing in Asia is not money, but investable project. It is always nice to have more investors, more money. So giving this nice ESG investing wave, I hear the question of what is the standards in sustainable investing? I think I didn't really hear these questions from the existing investors that we have in this room, also online, but this is also good questions for the new investors coming into the infra arena, especially in Asia. But I also have to tell you, this is not necessarily easy question for investing in equity, bond, PE, or venture capital. But when it comes, that's why we have a lot of discussion in EU taxonomy, SASB. Now SASB is actually kind of integrating into the IFAS Foundation-led initiatives. I'm pretty sure like a very interesting taxonomy will be coming out there. But when it comes to the infrastructure, I have a very clear answer. We should not reinvent wheel and use World Bank groups, IFC, and AMIGA E&S standard. E&S stands for environmental and social. Can we, yes, this is the page. IFC started to support private investors investing in infrastructure in developing country 1956. And MIGA started to do so 1988. So two together working about 30 to 60 years investing, supporting private investors investing in infrastructure in developing country. Since they use tax money, they have to have a clear bar. What is sustainable? What is good? So IFC and MIGA developed the standard and it documented it, applied to the real project, and modified the standard by reflecting inputs from their 180, I think 5 to 7 member countries and many private investors. As stated on this chart, their E&S standards covers wide taxonomies. They go beyond that, even E&S, they covers governance too. So that's actually include environment is not only the prevention and adaptations, but also pollution preventions, waste management. Social side is not just the community health safety, but child labor, land acquisitions, biodiversity, sustainable management of living natural resources and cultural heritage, and so forth, and governance, of course, include the corruption management. So this is the one, like many experienced institutional investors of infrastructure in Asia use them, and they are familiar with it. By the way, the document of this E&S standard is very long, I think about 1,000 pages, but at least available on IFC and MIGA's website, so please actually go take a look at it. Can you go to the next page? And also, when we apply this standard, we actually can do this before the investing, during the due diligence phase, as well as we can use this after the investing during the monitoring phase. By the way, we have a little bit of discussion probably today, not only the greenfield but also brownfield transaction, which we call asset recycling. But this standard can also be used in both greenfield as well as the asset recycling too. Can you go to the next page? But I have to ask one question. How far we should apply this standard? At this moment, I have seen MIGA as well as some private investors in this room apply it to the project level. But we could apply this standard to the investor company level or even to the supply chain. I think this is also the subject of the discussion. Thank you.
Thank you, Keiko, and thank you to Henry and Scott as well. There are a couple of threads which are coming out from the earlier discussion, the context setting by Henry, Keiko, and Scott, and I just wanted to quickly line up some of these things, right? The first thing, it's about consistency in terms of standards. We are not going to have a single standard, but let's look at making standards interoperable. Great news sharing by Ms. Honda about investors increasing their allocations to infrastructure. Infra investors are incorporating ESG faster than other groups of investors. I hear Ms. Honda talking about where are the projects, the pipeline of projects is important, and maybe asset recycling can then pump out a larger number of projects that institutional investors might be able to invest in. And finally, and I think most importantly, Ms. Honda shared, don't reinvent the wheel. So that sets a fantastic context as we move on into the discussion. With us here today are distinguished discussants from across the infrastructure value chain. I would like to call upon each of them to provide their quick views on the question. We have one question today, and the question, can we have it up, please? What actions can Asia take to position itself to encourage global investors to invest more in Asia's sustainable infrastructure? So I'll start off with Cheng Kai. As a financial services developer with the MAS, could you share some insights about how the MAS is thinking about these issues? You can speak into it.
Yes, thank you, Laban. The issue of standards and taxonomies is very pertinent to policymakers, and how we can encourage global investors to invest more in Asia infrastructure is also an important question. And these are issues that we think a lot about in MAS. But before we get into standards and frameworks, let me briefly touch on the initiatives to address some of the underlying challenges in Asia. First, project bankability, and this is an area where quite a number of speakers, including Ms. Honda, also mentioned earlier. I think we all know in emerging Asia, about 60% of infra projects are considered not bankable, and another 30% marginally bankable. So the issue, again, is not a lack of financing, but a shortage of quality projects. And it's due to various factors, such as inappropriate risk allocation, frameworks, or also insufficient project preparation. And Asia needs to address this to draw in more private capital. And this is where Infrastructure Asia is supporting governments in the region, on early project scoping, deal brokering, as well as sharing best practices in partnership with multilateral development banks and the private sector. Next, also on risk mitigation. And broadly speaking, commercial, climate and political risks, as well as complex legal frameworks, constrain access to financing and also limit private sector infrastructure investments in emerging Asia. And this is where Asia can benefit from innovative de-risking solutions to catalyze private sector investments. Earlier on, we heard from Gautam about the project undertaken by Temasek in collaboration with HSBC, ADB, as well as Clifford Capital on the Sustainable Infrastructure Debt Financing Platform. Another example, which I'm sure Primod will cover in more detail, is Bayfront Investment Management, which is also another asset recycling vehicle. And recently, they launched a sustainable tranche in their second issue. So I think all these innovative solutions will definitely draw in global investors to finance Asia sustainable infrastructure assets. And coming back to standards and frameworks, policymakers have an important role to play in providing clear and consistent definitions of activities that contributes to a low carbon future. For example, to move from net zero, without curtailing Asia's social and economic development, I think we need to shift the energy mix progressively. It cannot be a step jump, but able to facilitate a move to less emission-intensive fuels such as natural gas before renewables, renewables become more mainstream. And in this regard, taxonomies that do not cater to transition activities can constrain private capital flows to infrastructure assets. Again, we heard from Gautam that in Singapore, GFIT is developing a taxonomy for green and transition activities for our financial institutions. And transition-centric taxonomy is very important in supporting infrastructure, sustainable infrastructure in Asia's emerging markets. But this GFIT taxonomy is only for Singapore, and the discussion before this also alludes to a proliferation of standards and taxonomies. And this is where international collaboration is important. And to facilitate a more seamless cross-border capital flows into sustainable projects, taxonomies, again, as we heard from previous speakers, they have to be compatible. This does not mean that they have to be fully aligned or converge into a single set of standards. But it means that we should try to find commonalities across taxonomies and identify definitions and standards that are same or similar, so that industry participants can have the confidence that when they invest in infrastructure assets under one set of taxonomy, it is also eligible in another market. And this is important to unlock cross-border flows. And of course, within Asia, the ASEAN taxonomy is also aimed at doing that. It's built on the same principles, that of inclusivity of transition activities, as well as common baseline standards to facilitate sustainable financing. So I think, to round up, I think policymakers in Asia can definitely provide more clarity on transition activities that is based on science-based pathways, right? And also collaborate on taxonomy compatibility. And this will certainly make Asia sustainable infrastructure assets more attractive to global investors. Thank you.
Thank you very much, Cheng Kai, for your sharing. We also have a representative from the ASEAN +3 Working Group 1 on infrastructure financing. Could we hear from Mr. Suzuri Sakamaki from the Japanese Financial Services Agency? Mr. Sakamaki?
Thank you very much. Thank you very much, Ravan. I feel very honored to speak on this panel to discuss this very important question. What actions can Asia take to inspire global investors into investing more in Asian sustainable infrastructure? Japan's basic guidelines on climate transition finance that I'm going to talk about now are exactly one such action Japan has recently taken to mobilize more private capital to economic activities requiring transition, which definitely include infrastructure development projects. As has already been discussed earlier, Asia's infrastructure needs will enormously increase for coming decades. More than half of this infrastructure demand will be actually in the energy sector, such as gas, oil, and electricity. As we know, all of us are now running in the race to meet net zero carbon neutral targets. So fundamental question is, how can we meet this energy transition challenge? These energy sectors are often called, as already discussed, into hard-to-abate sectors. So Japan's basic guidelines exactly focus on these hard-to-abate sectors transition activities. So what is a transition finance? The basic guidelines define transition finance as a finance for supporting those fundraising companies who have set their goal target consistent with the Paris Agreement. Then the next questions are how fundraising companies should draw transition pathways and how global investors could trust these transition pathways. It is obvious that transition pathways are very diverse across regions, sectors, and even in individual companies. Nobody doubts, transition pathways will be changing dynamically over time. Under these circumstances, how we could make pathways credible among investors and other market participants. Then, to enhance credibility, the basic guidelines identified 4 key elements in the fundraising company's disclosure. Element number 1, transition strategy and governance. Element 2, business model environmental materiality. Element 3, science-based strategic targets and pathways. And the last element is implementation transparency. Actually, this disclosure framework is completely aligned with ICMA, ICMA handbook, but the basic guideline, Japan's basic guidelines has something more. In addition to this disclosure framework, to further boost credibility, the basic guidelines refer to what we call an industry-specific roadmap approach. In this approach, sectoral pathways, sector-by-sector pathways are developed at the national level, and based on which each company will formulate its own transition strategy. And then external parties evaluate the credibility of these strategies. I happily announced here on this panel, the first roadmap has been publicized. The last month, the Ministry of Economy unfolded a steel industry technology roadmap. And by the end of the first half next year, 6 more industries, chemical, electricity, gas, oil, cement, paper and pulp, sorry. These 6 more industries will see soon, hopefully, their respective technology roadmaps, which are essentially tools, useful tools for the industrial companies to comply with the basic guidelines. And these sector-specific technology roadmaps will certainly be shared among Asian counterparts for their reference, and English translation will be available hopefully soon. Having said this, I conclude my intervention by reiterating that Japan is fully committed to take any action possible to encourage global investors to knock the door and come into Asian infrastructure investment opportunities consistent with the climate goals. Thank you very much.
Thank you very much, Mr. Sakamaki, for your sharing. So we have heard from Cheng Kai and we've heard from Mr. Sakamaki, and I think what's quite clear from both their sharing is in Cheng Kai's sense, he was talking about the focus on a transition-centric taxonomy. Mr. Sakamaki was also talking about how do we build credibility for transition. These are going to be topics that we're going to talk about in the second half of today's session as well. So next, could I call upon Taufika to share her views, please? Taufika?
Thanks, Lavan. I think we are at a time where there are really 3 central challenges in sustainable infrastructure. First, we are hopefully coming out of the pandemic. Maybe some of us feel we're still very much in the pandemic, and we need to fuel growth to come out of this pandemic. And some countries, I'm from the Global Infrastructure Facility, which is housed at the World Bank Group. So my clients are emerging markets, and the incidence of poverty in the world has wiped out, by some estimates, about 20 years of improvements that we had made. So growth is really going to be central, and with growth delivering on the SDGs, the Sustainable Development Goals. And climate sits very much in our daily lives, from a user perspective, a citizen, but also from an investor perspective. We are not investing in the same way because climate has a cost, and we have to look at it, and it has risks also. And then how do we mobilize the financing? So I think we are here looking at item number 3. I think most of the participants have a financing investment background. I come from the other side, which is we're looking at how to address bottlenecks. I think Cheng Kai mentioned the lack of bankable deals. Asia is notorious. East Asia is actually notorious. There is a lot of interest given the size of the market, the size of the middle class, and the opportunities. But in terms of deal flow, I think most of the bankers here would agree that when the deals arrive, everybody is going after the same deals, and the pricing becomes extremely tight in a market where deals come once in a while. As I mentioned, I am with the Global Infrastructure Facility. Our main task is to work on structuring projects that can raise private financing. We have to date about 120 projects under preparation together with other MDBs in 58 different emerging markets. About 20% of those projects are in Asia, which is a very small representation compared to the size of Asia. So how do we work on this? I think we still continue working on the assets, because when we talk about sustainability, Keiko mentioned it with the ESG, the performance standards. You can look at investing at a portfolio level, but the individual assets make up the portfolio. See, so if your asset is not sustainable, is your financing going to be sustainable? I know I'm running out of time, but maybe I'll answer this in my next question. But this is one of the items that we have been looking at from the GIF side. It was mentioned at the opening by Gautam of HSBC. The GIF is a key founder of the Finance to Accelerate Sustainable Transition. And we have been working on creating what we're calling the Sustainable Infrastructure Label, working at the asset label. And this is really unique because even the IFC or the World Bank's MIGAs and all green bonds, sustainability-linked loans have always been linked to the financing that goes to the assets. Whereas here, we are approaching it saying, okay, let's work from the assets so that we're planning and building those assets to meet certain sustainability criteria so that when investors like yourselves come to look at those assets, there is clarity on what is being signaled as being sustainable. So maybe I'll stop here, and in my second question, I can bring up the fast infra work a bit more in depth.
Thank you very much, Taufika. Now may I move to Pramod. Pramod, Bayfront Infrastructure has pioneered some quite interesting technology to bring in a new group or get a group of institutional investors more familiar with infrastructure. Could you share a little bit about the transaction?
Thank you very much, Lavan. Great pleasure to be speaking to you and everyone here in the room, as well as the participants participating virtually. Bayfront was set up in 2019 as a platform to facilitate a new asset class around infrastructure debt. And this was really around trying to address this big and growing infrastructure gap in Asia Pacific of infrastructure financing. Now, what we do is create a bridge between banks that are looking to recycle their balance sheets and institutional investors that are trying to get to a investable prospect around infrastructure debt in a risk-reward dynamic that makes sense. What this does, it helps banks recycle their balance sheets to give them the opportunity to originate fresh transactions, and it helps institutional investors to get access to a diversified pool of assets, otherwise difficult to access. The risk-reward dynamics of the underlying assets, i.e. infrastructure debt, have proven to be resilient, given the kinds of sponsors, the off-takers, and the underlying importance of these assets. And as shown during the last 2 years, during COVID, a number of these assets performed extremely well, resulting in upgrades in some of the ratings of the notes that we issued out to the market. In June 2021, we closed our second infrastructure asset-backed securitization. That's what we call our product, IABS, which brought to market 5 listed and rated sets of notes, ranging from AAA to BBB. A notable feature of our structure was a sustainable tranche. 30% of the total size of the transaction was in the form of renewable projects, primarily wind, solar, run-of-the-river hydro, as well as desalination projects, electricity transmission, and road upgrade projects. So these fell into both renewable as well as social assets, together constituting a sustainable tranche. The order book was very well received, resulting in a green premium for the sustainable tranche, which priced at a premium relative to its conventional counterpart. We tightened pricing relative to an earlier transaction we had done in 2018, and we were able to bring in 50% in terms of new investors. The investors were primarily insurance companies, asset managers, MDBs, as well as banks. And we expect that we would be trying to mine each of these 4 segments deeper in future transactions. In terms of our future plans, we hope to be coming back to the market once a year. There are a number of initiatives around branding, pricing benchmarks, research, liquidity, as well as sustainability, which would be the key planks which we would use in terms of developing this asset class further. Thank you.
Thank you very much, Pramod. Very exciting indeed. Could I call upon Mr. Bertrand Jaboulé to share your views on this question?
Yeah, absolutely. Good afternoon, everyone, and thank you for having me. So, based really on the key takeaways of the discussions at S&P Global Ratings, with a few issuers, with investors, always relate to the problem of definition. And to me, what is really at stake here is how do we define what a sustainable infrastructure is? And to the key takeaways, from our works is really that you need taxonomy, a clear taxonomy. Today, we are in this kind of trial and error phase where you have a proliferation of taxonomies, but over time, taxonomies have to converge so that we have consistent and coherent eligible categories with clear performance thresholds. That's one. Then we need a form of social taxonomies as well, because social implications are extremely important for infrastructure projects, especially in developing countries. And overall, I mean, Henri was mentioning earlier, fast infra. I think that a form of infrastructure label or certification or standard, I mean, you name it, would help a lot, because those standards, they give a lot of credibility to the underlying project, and therefore a lot of comfort to potential fund providers that their money will be put to work where it's most impactful. So those would be my takeaways.
Thank you. Thank you very much, Bertrand, for sharing. Finally, could I invite Nishant to share?
Thanks, Lavan, and hello, everyone. It was interesting to listen to words like project bankability and innovative de-risking solutions that Chenkai mentioned, and some of the other panel members as well, right? And look, as some of you may be aware, I work for GrantCo. We manage, we are a DFI, handling Africa and Asia, and channeling private capital in sustainable way and infrastructure projects in poor and emerging economies. Now, I mean, an interesting thing that I have been noticing lately is the reverse inquiry coming from institutional investors like insurance companies or even pension funds, right? Because especially the regional headquarters of global insurance companies, because they are getting, I mean, I would say beaten down from their global headquarters to go sustainable. And there aren't enough asset for them to look into. And what really happened recently is that when we started working on a green bond transaction in Vietnam, contrary to our expectations, the inquiries and interest has been overwhelming from insurance companies. And so much so that for them, as long as we manage risk for them and ensure that the projects are bankable, right? I mean, as insurance companies, for them, the primary aim is capital is protected. So as long as those instances are taken care of, and there is no greenwashing, right? I mean, and it's genuine green or sustainable certification. They are ready to take even some naked exposure on the bond, which is what we want to be promoting more and more in the region. So, I mean, we as you are aware, Lavan, we are working with your institution on an affordable housing platform across Asia, which is where again we can bring in, for institutional investors, we can bring in like transition towards IFC Edge certifications, right? And then give them access to an affordable asset class affordable infrastructure, by means of risk sharing for them. Thank you.
Thank you very much, Nishan. And no, it's quite interesting to hear about your solution and something Chenkai mentioned at the start of the conversation, which is in order to get more private capital, the risks of the projects have to be well mitigated. So, we can start to see some joining of dots already. So, no, thank you for that sharing. We have now heard from our discussants, and I'm mindful we're running slightly short on time, but I thought I'll mix it up a little bit now, and I want to give each of the discussants that I'm going to call upon maybe about 30 seconds, right? Let's take a little bit more of a blue skies approach. I'll ask you to wear a different hat from the hat that you normally wear. And, wearing that hat, what is that one thing that you would do in that role, right? So the idea here is for all of us to appreciate, right, some of the complexities, some of the competing wants and needs in this, and for our virtual audience as well. So first, may I start off with Pramod? Pramod, wearing the hat of an MDB or a government official, If you could do one thing, what is that one thing that you think would make the most bang for buck?
One of the challenges we face in our model is a currency mismatch. We would like to make available US dollar product to institutional investors because that's how they invest. However, projects are increasingly moving to local currency in a large number of jurisdictions. If I were an MDB using the immense resources at my disposal, I would arrange for swap lines to be made available to banks that participate in this particular sphere. These swap lines would enable banks to deliver in a number of currencies where the swap markets are not adequately developed, long-dated currency swaps, such that we would be able to acquire US dollar product, even though the underlying transactions are local currency denominated, which we could then structure and make available to institutional investors. So that would be my wish list, swap lines for banks, long-tenured.
Thank you, Pramod. No, that's interesting. Bertrand, similarly, wearing the hat of an MDB or government, one initiative.
Well, I think to promote transparency in the market, I would subsidize heavily certification providers, external assurers, just to give comfort to investors, again, on the transparency of the underlying transactions.
Thanks very much, Bertrand. Switching it up a bit, Taufika, if you were a private sector, what is one initiative that you would do or you would like to see happen?
Well, as a private investor, maybe ask two MDBs would be, to be able to deliver on sustainable infrastructure in more challenging markets, but in general, our transition, we do need access to blended finance, and it does facilitate when there is risk capital that is there. There are a number of initiatives out there. It's a confusing market. So when we talk about consistency in labeling, consistency in definition, finding coherent and really summing up where the opportunities are. When investors, I think we're really seeing a shift in the market. It's no longer good for business, but it's really about doing business where investors are looking. It's no longer just CSR, but really investment strategies are being developed around SDG commitments. So having access to blended finance solutions that are clear. I think there is, for example, the Green Climate Finance Facility in South Korea. We as in MDBs as well as the private sector have access to the GCF. It's a long and complicated process. We see more and more foundations also coming into this place with very large sums of money, so non-negligible amounts of money. We ourselves are working with Bloomberg Foundations and Rockefeller to develop pipelines to look at risk mitigation instruments. So providing clarity on what's out there, what are the process of accessing those funds in the design of facilities that private investors are looking at.
Thank you. Thanks, Taufika. And finally, Nishan, from your perspective as a private investor, if there was one initiative.
Thanks. I think Taufika already stole my thunder with the usage of word blended finance, right? But look, I would like to say one thing, and my wish list with MDBs is, there are a lot of institutions or MDBs or DFIs who are doing similar things. And, and a lot of them or most of them are not talking to each other or interacting with each other, right? I mean, I work for GrantCo, there's Bayfront, there's similar institutions. And we provide local currency solutions. There are institutions who provide hard currency solutions, right? So why can't institutions, 2 or 3 of these institutions join hands and work towards a common goal? And the second one, wish list for me would be from MDB and DFI community is to crowd in the private sector and not crowd out. And we've been seeing some instances in some of the challenging geographies where crowding out is rather happening than crowding in. So these 2 wish lists. Thanks.
Thank you. Thanks, Nishan. So before we go for a break, please allow me to summarize some of the ideas and the thoughts that are coming up, and especially from the last session, right? From the quick fire round, as I call it. These are terms we've heard before, but the fact that they come up again just tells us how important they are. The role of blended finance, coordination, as Nishan talked about, and how do we deal with currency mismatches, especially if more products are going to move towards local currency. So these are some of the issues that we will have to tackle. We will pause for a short 5-minute convenience break, and please be back here at 4:10 p.m. Ladies and gentlemen, welcome back, and welcome back everyone who is joining us virtually as well. In the second half of today's program, we are focusing on the critical topic of financing the energy transition, which was talked about by some of our discussants earlier. Energy is in the spotlight, with the demand for energy in Asia growing at double the global rate. Despite this, we should not lose sight of the goal to transition using cleaner energy, while at the same time securing our energy needs. In this discussion, we seek to address innovative financing solutions to help Asian economies in the energy transition. To set the stage for the discussion later, may I invite Henry back to share some insights on this topic. Henry?
Thanks, Lavan. Okay, next slide, please. So I'll try to do a very brief overview on a complex subject, obviously. Can you go back? Yeah. So first, I think if we look at governments around the world, so what we've seen in response to the pandemic is the use, the increased use of infrastructure as a way to get the economies to recover. So we actually sort of worked with the G20 countries and went through all the packages that were issued since the beginning of 2020. Next slide. And what we see in terms of economy, in terms of priorities, is that decarbonization. If you can go back to the next slide. Yeah, so decarbonization after obviously economic growth was one of the key the key direction for investment, as you can see here. But it's important to note that yes, it is important, but I think economic growth and equity and innovation were also very much present in those packages. And what's important as well, decarbonization from a government perspective actually not only focus on energy but on other sectors as well, because I think government do recognize the complex nature of transitioning other sectors beyond energy. So again, it's not probably the type of size that would have wanted in terms of investment. And if you compare those numbers to the International Energy Agency number in terms of requirements, as you probably all have seen, they're calling for 4 times more investment in renewables and a complete stop in investment in anything coal or gas related, which obviously, as we discussed previously, is a bit of a challenge when your economy is growing and you kind of need that power right now. So I'll stop there. We have all the numbers that are now public in what's called the Infra Tracker. Next slide. All right, so that was for government. When it comes to NDBs, you probably will have seen a lot of announcements as well around their increasing focus on climate finance. And so I think most of the NDBs are transitioning even more rapidly than before the entire portfolio towards transition and climate finance, both from adaptation and mitigation perspective. So again, I think that there should be more opportunities to partner with NDBs, and the same happens obviously in Asia. So that's for NDBs. Next slide. Now, when it comes to investment, we sort of looked at the trends across projects, and what we can see in emerging Asia, as opposed to the global to sort of global transactions, is that renewables are really sort of king at the moment globally. They really are the sectors that sort of attracting most of the investment. The reason is that the transition pathways for those is pretty clear. I think, again, as I mentioned earlier, there's not a lot of stress around whether those assets will still be compatible with whatever transition pathway happens to be in sort of 10, 20 years. I think when it comes to the other asset, that's a bit more of a question. So again, the renewables have a lot of wind at the moment. In Asia, a little bit less as a proportion of total investment. They're still slightly increasing, but I think the region is definitely could leverage more the appetite from global investors into renewables. Next slide. Right. In terms of how those things are being financed, what we're seeing is, and here we don't have the total market, but what we're seeing is an increasing use of capital markets as a way to finance funds and projects in developed economies. When it comes to emerging economies, obviously access to capital markets for greenfield projects is a lot harder to get. Yep. Sorry. And am I still on the? Wait. Sorry, I heard someone else talking. Apologies. So the capital market is increasing is increasing quite a bit, and obviously a lot of it is sort of green bonds, which is the larger, the fastest increasing share in the graph I'm showing. So that's for the private sector. Next slide. So besides those sort of green bonds, what we're seeing as well is something that I touched on previously as well, is the increasing sort of ratings. The investors are increasingly sort of rating their assets, not so much in Asia yet, but around the world, and they're making sure that those ratings are increasingly positive. One of the main reasons is that this is one of the key criteria now for investors, and chief among them are insurers and pension funds, which are very much looking at those ratings before they can buy brownfield assets, as you can see on the right hand side. All right, next slide. And so I think, and very keen because we have great speakers after me. I think that one of the key things that we've learned working with different countries is that actually there's a lot of innovation out there. So it looks complicated, and I think some of the previous speakers have mentioned how difficult it is to actually create bankable projects that also sort of fit all those taxonomy, label, etc. But what we've seen is that it is actually possible. And so one thing that the GTM is very keen to work on is accelerating the exchange of innovation. And here you have a couple of examples of tools that we're trying to develop, and we want to continue to develop them with partners. So it's a bit of a call for action on behalf of the GIA Hub, is that if you have great innovation that you think could be beneficial to other regions or to other countries, please reach out. We're very happy to sort of continue spreading those innovation around. Thank you.
Thank you very much, Henry, for sharing your insights. I would now like to welcome Scott back to share his comments on this topic of financing energy transition. Scott, please.
Right. Well, as an investor and dealing with people who we invest money on behalf of, one of the most difficult concepts to get them to grasp is transition financing. The rule-based approach that has been used for ESG by many investors, which arbitrarily assign ratings to industries. So, for instance, if you're a coal-fired utility, you're automatically blacklisted, rather than asking the harder question, which is, what is your transition plan? And to ask for a utility that wants to make the transition to forego the revenues that are being driven off of their existing assets is a bit unrealistic. And so we are seeing, of course, the transition financing be more widely accepted through the use of green bonds. Ford, of course, did one just this week that was for $2.5 billion, the largest green bond done. But the issue, I think, in the market is getting people to understand transition financing, how you define accountability under transition financing, and then the realities of transition financing, which there are a number of them, because it's very difficult to deal with stranded assets in the short run, especially if you're in a growing economy. a lot of the money that gets spent on that would be raised for transition financing would be for not necessarily to retire existing output, but to augment it with more energy or environmentally friendly technologies. There's also an element of what I call political reality. And we're seeing political reality, that issue right now, play out in China, which had taken on a very aggressive stance in terms of transitioning the economy away from coal, but now has suddenly found that they have to fall back on coal in order to maintain their economic activity. So the element of the political reality, it really requires both a commitment from the utility or whoever the entity is that would be looking for the financing and coordination with their governments. Of course, that also, when we're talking about greenfield, would also require coordination from the standpoint of risk mitigation, both from the standpoint of the impact to the economy or to the environment, and also how to mitigate the risks associated with the greenfield nature of the project. Will it be done through tax incentives? Will it be done through government? Will it be done through government cash incentives? But things that can be techniques that can be implemented to encourage it, whether it be done through the government or through some sort of private sector pooling of interest around that kind of thing, which would be a new financial innovation, which we have yet to see. But on that, I'll turn it back to you.
Keiko, would you like to add to Scott's comments?
Well, thank you. The transitional financing involves both corporate finance and project finance of the infrastructure. Since Scott covers more on corporate finance, let me focus on the project finance side of the energy transition. Since energy transition policy of the most of the even developed countries are not available, so as the, of course, developing countries, therefore, what we can say or we can think is limited. Having said that, we cannot really wait until the all countries kind of lined up the strategy. So therefore, let me state what we can say, what at least we can do right now. But before answering to the question, let me share one fact about population growth. Japan is not only the country hit the peak of population. According to the UN, Italy, Spain, Portugal, in addition to the South Korea, have already hit the peak. Germany, France, and Netherlands will start decreasing their populations between now and 2045. But ASEAN will continue to grow their population at least until 2060. So in Asia, we need to add energy capacity while making it more sustainable. This is the challenge that we face in energy transition Asia. That's why it's really, really difficult. So as for adding the energy capacity, that's the first one. It would be ideal to have renewable as much as possible. There are many discussions going on in this area, so I am not going into the detail. But as for the existing facility, I have two proposals. The first one is asset recycling of renewable energy power plant. Please go to the next page. This is an example of hydropower project in Indonesia that I had a pleasure to serve in my previous capacity. To build a power plant, you need to prepare the project by developing rough scheme of the project and going through the procurement to select the investors. Then we need to work on the details of power purchase agreement, and operations and a management agreement, O&M agreement. We also need to select the construction company and enter into EPC agreement. So this is not easy for first-time infra investors. In addition, I have to say, construction of power plants sometimes, some people say often, takes longer than originally planned. Therefore, I would like to propose the experienced investor who currently owns the brownfield renewable energy, which the construction is already finished, to consider sell the equity over the loans that you have. I think, I'm kind of hearing there is already fund set up, which is really wonderful thing. I'm pretty sure this is the time you may be able to exit with some premium. But doing so, the new investors, including some institutional investors, can come in. Then the experienced investor can move on to the greenfield project. Can you go back to the previous page? We also have to need to think about what to do about the brownfield coal-fired power plant. I heard wonderful news recently. Asia Development Bank announced to prepare some facility to support the early retirement of coal-fired power plant in Asia. They will start to work with the Indonesia and Philippines first. The details of the facility has not been announced yet. At this moment, there is a big gap of the value of the loan to hold until the maturity, which is close to, let's say, 100, versus selling in a market. So it could be very challenging to develop the great facility. Having said that, if this facility can provide strong motivation for private investors and lenders of existing coal-fired power plants, I think it will be a breakthrough. So therefore, I think although best, I would recommend to keep an eye on this ADB thing. But at the same time, one thing, like many of us in this room, or possibly on online, who are the brownfield renewable asset owners, please consider to take some move. Thank you.
Thank you, Keiko. Next, we will move the topic further with our distinguished guests that are with us today. Can we have the first question up, please? The question we want to answer is, what are some of the strategies to mitigate the energy transition risks for investors, financial institutions, and developers? And here I wanted to draw on some of the threads that were coming up from both Scott and Keiko. They're starting to already talk about the fact that, in the future, there could be some assets that may start to become stranded. So may I call upon Nar Singh from Black & Veatch to share your views and maybe try to address the topics that Scott and Keiko are talking about, that eventually we could start seeing some assets that are stranded.
Sure. Good afternoon, everyone. It's a pleasure to be talking to all of you. Look, the easiest solution for decarbonization is to retire all the coal plants and start switching to hydrogen, green hydrogen. But we know it's not possible. And we saw it in China and in many other countries, including India, as they were facing shortage of coal. You need to provide power to the people. So there is a step approach here. What we are seeing, Black & Veatch as a solution company, we are seeing customers wanting to blended fuel. So along with coal, you could use natural gas, you could use biofuel, and you could also use hydrogen, depending on the availability. Statistics that I have, which we have done some work for some customer, is if you are able to put 20% natural gas in the system, you could reduce your carbon footprint by 9.7% on a coal plant of 500 megawatt. So it's a substantial reduction. Now, somebody might ask, why not do a 100% switch to gas? But that brings down the efficiency of the overall plant significantly. In those cases, what we are recommending is changing the coal-fired power plant and the boiler with a combined cycle power unit. And you could easily do the swap on that particular block if you don't want to make the rest of the balance of plant redundant. So that's one solution. The second solution that we see in the market is also with respect to storage, energy storage. I mean, it's not being as adequately used in Asia as we are seeing in US. There's a lot of usage of battery energy storage or other kind of storage solutions. So what can we do more on that particular aspect? And the third aspect is, if we are planning to bring gas on a coal-fired plant, sometimes it's not economical because of the quantity of gas that you bring. And you could put peaker plants along with that, which could enable you to go merchant on some of those plants and bring the economies back into action. So those are some areas. I mean, obviously, there are a lot of other areas that we are working on hydrogen generation. Currently, the technologies exist. You could do 40 to 50% hydrogen on a power plant. But none of the turbine manufacturers are able to do 100% today. But it will become a reality. We have a project right now in US where we are the owner's engineer and we are doing a blending of 40%. But what we are doing is we're getting the whole plant ready for future to be 100% ready. So for a greenfield plant, instead of planning for 30%, 40% hydrogen, you could right now plan it for 100%. Then you don't need to do a major infrastructure change later on. So those are some thoughts. There are a lot of other ideas as well. Thank you.
Thank you, Narsingh, for sharing. Neil, Brookfield recently raised a large sum of money to focus on energy transition. Could you share what are some of the opportunities that you see?
Yeah, thank you, Lavan, and good afternoon, everyone. Thank you very much for your time. That's correct. So Brookfield has been owning and operating and developing renewable power assets for close to half a century. And today we manage about $60 billion of renewable power generation around the world. But what we've realized over the last 5 to 10 years is we've been evolving from just simply developing, owning and operating renewable assets to partnering with companies as they're looking to decarbonize their businesses. And a large part of that has been around supporting their energy transition. And more recently, some of the things that we've observed are clearly companies all around the world are making commitments to net zero. And Sakam-san mentioned that before. And facing stronger and stronger stakeholder pressure to make those net zero commitments. The challenge is, in order to achieve those net zero commitments, they need both capital and expertise. And in many cases, those companies have the right intentions, but lack either or both of capital or the technical expertise to make that decarbonisation trend occur. And what we started to realise that also was, as companies moved down that net zero curve, a significant amount of value was extracted from their businesses. And that provided the window through which private capital could participate in that process, either to simply finance all of the capital required to help companies move down their net zero curve, or to provide the capital and the technical expertise to achieve that. The more and more we began talking to companies across various industries, the more we realized that the technologies in many cases already exist. To be able to achieve this, it was simply applying the combination of capital and expertise. And as a result of that, last year we launched a program to bring together large institutional partners from around the world to consolidate capital, to come together to support industries decarbonising their processes. And much of that started with speaking to companies purely about their Scope 2 emissions. And once you look at how to help companies transition away from their Scope 2 emissions, it moves to how do they think about their Scope 3 emissions. And what we found is as we've talked to institutional investors around the world, including large institutional investors here in Singapore, the ability to assist in partnering in that process and the value that can be extracted from that investment was quite an attractive commercial opportunity, as well as the benefits of decarbonisation. And that's been really the result of what we've been looking at. It's not about investing in green infrastructure. In order to decarbonise, you need to go to where the carbon is. So it is investing in dirty infrastructure assets, in dirty businesses, to help them go through that process. And it's really focused on three areas. One is business transformation, simply going into companies and industries, understanding their business processes, understanding their procurement processes, their industrial processes, and working out where the carbon is generated and how to transition them away from that. The second part is just expanding the clean energy stack in grids around the world. And then finally is just enhancing clean energy and the circular economy. And that's really what we've been working on with institutional partners around the world.
Thanks, Neil, for the sharing. I think you raised an important part that the challenges are immense, and partnership that's going to be very, very important going forward. So thank you for sharing that. I think we would like to hear from our regional representatives, ASEAN Plus 3 Working Group 1 members. We have Mr. Michael Sino-Cruz from the Department of Energy in the Philippines. Mr. Sino-Cruz, would you be able to share your views, please?
Okay, thank you. Good afternoon to everyone. I'll be making a short presentation on the Philippine Energy Transition Path that we have adopted so far. So next slide, please. Okay, just recently we published the Philippine Energy Plan. This covers the period 2020 to 2040, and under this Philippine Energy Plan, it integrates the energy transition path of the Philippines, and from from reference scenario. So to be able to arrive at a clean energy scenario, we have accelerated the penetration of renewable energy, as will be presented in the next slide. And as well as energy efficiency, and even we are looking at other technologies such as green hydrogen, as well as nuclear, and the application of ICT and resiliency. All of this will support our strategic directions on energy security, sustainable energy, resilient infrastructure, as well as on competitive energy sector, smart homes, and empowering consumers. Next, please. So this is the, when we passed the RE law way back in 2008, we formulated several policy mechanisms. We implemented FIT, we developed our National Renewable Energy Program. We also now doing on net metering program. We have formulated a policy on green energy option program for the consumers. The consumers will have the choice now to select among the eligible RE developers or suppliers to get their electricity. And we are also implementing right now the renewable portfolio standard, both for grid and off-grid area. And now we are will be also implementing the green energy auction program. This is a reverse auction. Will identify how much capacity of renewable that we need to be able to support the RPS, or the renewable portfolio standard. And from this identified capacity, will invite bidders per technology. So this is the GF. And we also looking at the RE market to trade for the certificates. They can buy the certificates here to be able for compliance to RPS. Next, please. So under the Philippine Energy Plan, our goal is to increase the RE share by 35% under the reference scenario in 2030. Up to 2040, but in the clean energy scenario, our target is much higher. It would be 50% share of RE by 2040, and this target will support our objective of energy security, lowering our dependence on imported fossil fuel, on sustainable energy development to be able to protect our environment, on climate change, reducing the greenhouse gas emission, on capability building in the industry that would provide additional jobs. And lastly, on inclusive growth, providing or utilizing renewable energy in remote parts of the country. Next, please. Aside from renewable energy, we also now have this Energy Efficiency and Conservation Act, which was recently passed in 2019. And among the significant provisions of this act is the adoption of the local energy efficiency conservation plan. So we are now mandating the local government units, municipalities, cities, provincial, to be able to formulate their respective energy efficiency conservation plan. So they need also to establish an office dedicated to energy efficiency. We have also categorized the establishments, type 1 and type 2, depending on the electricity consumption. And for type 1, they need to have a certified energy conservation officer. And for type 2, they need to have a certified energy manager. And we also implement the minimum energy performance standards. Next, please. So based on the our targets on RE, the 50% share on energy efficiency, increasing the blend of biofuels, and the penetration rate of electric vehicle, we have come up with our clean energy scenario. But for this slide, I will just present the power outlook. By 2040, we'll be needing around 95 or 96 gigawatt under the reference. And under the clean energy scenario, we'll be needing around 119 gigawatt. So this is about 30% higher. The requirement capacity under the CES is about 30% higher than the ref because of additional capacity that we need because of the entry of more renewable energy, specifically variable RE such as solar. But as you can see here, that from the right side, the power generation, from more than 50%, around 57% share of coal, under the reference, because of the 35% share of renewable, it will go down to around 25%. And it will further go down under the clean energy scenario to about 23%. So we'll be needing natural gas. Natural gas will be contributing significantly under the reference, around 40%, but in clean energy scenario would be around 26%. So based on this, next slide, please. Based on this, this is the investment requirement that we need. The energy outlook or the Philippine Energy Plan would require around 142 billion US dollar under the reference scenario, and under the clean energy scenario, it would be around 153 billion US dollar. I'd like to get your attention to the investment requirement on power generation. The 104 billion US dollar that we require and for the power generation, 76% of that should be investment for renewable. And under the clean energy scenario, the investment requirement for power generation for around 115 billion US dollar, more than 80% of that should be invested in clean energy scenario. I think this is my last slide. Thank you very much.
Thank you, Mr. Sino Cruz, for sharing about the Philippines Energy Plan. We also have Mr. CFA from China PPP Center. I would like to ask you a slightly different question. How do we help Asian economies transition to more sustainable future through innovative financing that can unlock green or transition capital?
Okay, thank you, Mr. Levin Feilu. It's my pleasure to attend this meeting and share Chinese practices. In China, PPP is regarded as an instrument of modern governance and has made great achievements. Next, please. This slide shows some cases on PPP promoting quality and innovation in the field of green and sustainable development in China. The first project is about water-saving irrigation. The second one is smart agriculture, saving fertilizer and pesticide, and facilitating farmers' financing. The third one is an EOD project with underground wastewater treatment plant. The fourth one is an EOD project about rural household waste disposal. The fifth one is a TOD project, a subway express with A plus B packages. How does China promote PPP? Next, please. Next slide, yeah. First, to build up a PPP regulatory framework, except for laws and policies, we pay high attention to operational guidelines and templates in order to standardize the process of PPP project preparation, procurement, and operation, including how to prepare PPP contract, business case, value for money assessment, and fiscal affordability assessment. Next, please. Second, to set up PPP institutions, such as PPP unit at central, provincial, and municipal or county level. Especially those at municipal or county level play very important roles because they are the direct managers for a specific PPP project. To facilitate a PPP project, usually a leading group chaired by the mayor will be set up for coordination among departments. Meanwhile, consultancy is encouraged by Chinese government and is widely employed by project owner for project preparation, procurement, so as to enhance the quality of project proposal. Next, please. Third, to manage the nationwide PPP project through a PPP information platform operated by China PPP Center. Project information is input by local PPP unit, reviewed by provincial PPP unit, then checked by China PPP Center for registration in a project database and disclosure to the public. China PPP Center can reach out each PPP project. Now there are more than 10,000 projects in the database. Next, please. As to experience sharing, number one, it is valuable to standardize project development process to reduce transaction cost and management cost. Number two, the online monitoring and disclosing fiscal affordability of local governments can prevent fiscal risk. Number three, the information transparency can improve PPP business environment so as to attract more private sectors and financial institutions. Lastly, the high competition results in selecting better private sector to ensure project quality and innovation. You can see the snapshot of PPP payment committed by a local government in the PPP platform for monitoring its fiscal risk. That's all. Thank you.
Thank you very much, Mr. Xie, for your sharing, and we definitely agree with your thoughts about standardizing project development, which helps to reduce transaction costs, and transparency also helps to crowd in private capital. So thank you for your sharing. Now I would like to turn to Kelvin. DBS has been leading the way in energy storage systems. What are some of your thoughts on unlocking green capital?
Thank you very much. As we all know, for energy transition to actually work, we need an effective storage system to go along with it, right? I think the main problem that we have today is we have a lot of renewable deployment, but not enough energy storage systems being deployed in a commercial way and at scale. And we actually believe at DBS that commercial energy storage systems not only complement what is being available today, it's actually, in many cases, strengthens the local grid as well. So late last year, we, together with two other financial institutions, we financed APAC's only standalone project financing for a battery-only storage system project. This is the first in APAC, I believe, until today. It is still the only one. It's a 100 megawatts, 150 megawatt hour DC, AC kind of a system. It's meant to assist with quite of the provision of the ancillary services required by the grid operator, and it's done under a long-term contract with the relevant gentailer in Queensland, Australia, right? And we believe that this will provide a template for Southeast Asia, given that there's a huge need for this sort of systems to complement the solar and the wind projects that are being bidded out today or being developed all around us, particularly here in Singapore. And we believe that this transaction should create a template for future transactions to be done, whether as a standalone project asset or in conjunction with a solar and wind kind of greenfield project. Actually, battery storage is not the only way to go. I think hydrogen is also being spoken about, but particularly green hydrogen. And we believe that's the next frontier to be kind of targeted from a financing point of view. Currently, it's still too early to talk about that. I think there's a need for various mechanisms such as blended financing, as mentioned by a few speakers before, grants and so on and so forth, as we've seen in Australia, as well as viability gap funding to help this technology to be commercialized and to be deployed in a big way. I think we also received quite a lot of reverse inquiries from companies. So as Neil mentioned just now, it's not just about projects and assets and so on. I think we cannot decarbonize and transition if we do not get the companies along with us. And we have a lot of reverse inquiries from companies who are interested to do transition financing, transition bonds, sustainability-linked bonds, and green bonds. And at DBS, even here in Singapore, we have done quite a few issuances, including helping government agencies and bodies to issue kind of green bonds. And here in Singapore, for example, we helped NEA, who is the first Singapore government body to issue a green bond. And we believe that this sort of move will help from the government to actually accelerate and catalyze the deployment of green assets infrastructure where it's needed in the various countries. So in short, it's not only batteries, energy storage systems, hydrogen, but I think we need to look at whatever available technical solutions there are and the financing techniques that can help to deploy these things rapidly.
Thank you very much, Kelvin. Next, Pradeep, there was a recent announcement by ADB on the energy transition mechanism for Southeast Asia, and Ms. Honda talked about it as well. Could you share more insights?
Sure. Thank you very much, Thuru. Are you able to hear me? Just want to make sure that okay, great, wonderful. Firstly, thank you for having ADB join this really important discussion. I think the topic of transition finance is really key. If I may just step back a little bit, I think the question was more broadly about MDBs and transition finance. So Asian Development Bank as an MDB, I think, is uniquely positioned to support transition finance in our region. We've been investing in projects for over 5 decades, first of a kind projects, be it geothermal projects, the first international reverse auction for solar in Cambodia, for instance, the first issuance of climate bonds in the region, or project finance for floating solar in Vietnam. So these are just a small number of examples of the kinds of projects that we've been involved in. The second is, I think MDBs also provide, they have a certain element of trust that they can bring to bear. with clients and with projects. We are owned by kind of developing member countries and countries outside of the region. And we are often serving as an honest broker, bringing together investors and project owners and governments. And we work both at the policy side of things and also at the actual project investment level. And the third is our ability to bring together blended finance tools and solutions. We have our own resources, but we are able to also crowd in concessional resources from our donor members and also from global climate sources. And increasingly, we're also discussing with large mega philanthropies who are quite keen to actually deploy their resources through us to support energy transition or broadly transition efforts in the region. And then we've also got access to commercial partners who we're able to crowd in. So I think these are the three sort of key attributes, if you will, or qualities that help us to be able to push transition finance in the region. Let me just briefly talk about a couple of examples. You mentioned ETM. So the Energy Transition Mechanism, or ETM, is something that we've been working on since earlier this year. And we're primarily focused on legacy or existing coal-fired power plants. Now, these plants are a problem because most of the power plants in Southeast Asia in particular, and in Asia Pacific in general, are relatively young. They're about 12 to 15 years old. And as you all know, these are very long-lived assets. They're continuing, they will operate for another 20 to 30 to 40 years. And let's look at the ownership structure of these plants. They are either privately owned or international power, independent power producers, or they're owned by large state-owned enterprises, or they are state assets. Now, in the first case, in the case of IPPs, most of these plants are shielded or are functioning under long-term contracts, offtake contracts, or power purchase agreements, which means at the market forces, they are insulated from market forces. So even as operating coal plants gets more expensive and renewables get cheaper, these plants don't have to do anything. They will continue to operate because they are by contract allowed to do so. So we really need to think of financial incentives to be able to allow for these plants to be retired earlier than usual. And you've got the same issue on the state-owned or the government-owned plants as well. Again, they may not have power purchase agreements, but in often cases, tariffs are subsidized, prices of coal is a pass-through, and there is a surging energy demand in these countries. So you're not going to get power systems operators and governments to shut down these plants unless they know that there's replacement renewable energy being put in place. And that takes money, and a lot of these SOE asset owners are often cash starved and not able to make the necessary investments. So with that in mind, ADB is putting together and developing the Energy Transition Mechanism, which is really a blended finance approach. And it's not a single one-size-fits-all approach. We call it the Swiss knife, or the Swiss Army knife approach. So depending on the asset owner, depending on the type of asset, and depending on the country and the political economy, we may have to look at different ways of actually executing these contracts. Just very briefly, we've outlined three different ways of doing it. One is the acquisition model, which typically you have ETM essentially buying out the existing owner equity and taking over the debt and operating these plants for a shorter period of time than they would have otherwise been operating, because we're using a cheaper blended capital. And so we're able to actually operate these plants for fewer years and then take them off the grid. So that's the acquisition model. The second is a synthetic model, where the existing owner stays on and continues to operate and maintain the plant, but we re-lever the project. And we're able to buy out a bulk of the equity of the existing owner, but then the owner keeps enough skin in the game for them to be able to be accountable for operating the project and decommissioning it down the line. And in return, the owner agrees to shut down the plant or to repurpose the plant. It's not always shutting down or phasing out, because there are increasingly good examples of how you could repurpose coal-fired power plants into renewable energy projects, into data centers, into energy storage projects, or co-firing with biomass, and so on, that is being looked into. And the third is a portfolio approach, where when you look at large SOEs that have large number of coal-fired assets, there are ways in which you could potentially structure a corporate loan facility to the SOE and to build replacement renewable energy and grid upgrades, And in return, the asset owner agrees to a gradual phase out of these power plants over time. And these can be results-based, they can be based on certain KPIs, and the loan terms can vary as a function of whether they reach those KPIs or not. A few key measures here to keep in mind is, firstly, this transition is gradual. We're not talking about overnight shutting down of coal-fired power plants, because we know that is simply not viable. In our region, where you've got between 3 to 6% year-on-year increase in energy demand. Secondly, it's going to be systematic. So there's going to be a lot of studies done in terms of what's the impact on the grid of taking certain plants off the grid. What is the amount of renewable energy and storage that's required? And where in the grid does that need to come in? What is the impact on price? And the third aspect is people. Any transition is about people. It's about people that are leading the transition, be it system operators, investors, government agents, agencies, policymakers, and also people that are affected by the transition. So we want to make sure that the transition is just, equitable, and affordable. So we are also looking into making sure that those impacts are adequately projected, accounted for, and then supported through grant financing and other sorts of concessional resources aimed at reskilling, retooling, systems, perhaps accelerated retirement programs, and other sorts of support that communities would need. And so this is a program that we're developing with an initial focus on Indonesia and the Philippines. Jointly with the finance ministers of both those countries, last week ADB launched the ETM partnership at the COP26. So we're currently undertaking a feasibility study, looking at the nationwide fleets in these countries, looking at the age, the impact on the grid, the cost of retiring these plants over time, structuring different types of financial mechanisms that would be applicable. We are networking with potential investors, commercial financing entities, philanthropic sources of financing, bilaterals, and also with global climate funds. And we're hoping that we will be able to at least have a few pilot transactions identified and well-defined by the middle to end of next year to be able to pursue them further. And just briefly, the other sort of transition finance area that MDBs are well positioned to support, and that's come up quite a bit already, I think by earlier in the day, is ESG bonds, transition bonds, climate bonds, social bonds, green bonds. This is a very new area. Southeast Asia is ramping up. Year-on-year growth is stupendous, but it's still a very small percentage of the global issuances of these sorts of bonds. And I think there's a huge, potential here. I think people have already talked about it, because when you want to promote these sorts of bonds, you need to develop the ecosystem of service providers and the marketplace. You need regulators to be on board, the Securities and Exchange Commissions. You need the second-party opinion providers. You need verifiers, certifiers. All of that has to be developed, and we are working on that. We support the ASEAN Green Market Forum, the Green Climate Forum, and also we are supporting the training of verifying agents in different countries. We're also supporting issuers, both sovereign and the private sector, to be able to give them the technical advice, to be able to identify assets, to be able to pool them together, to develop frameworks, and to support their issuance. And finally, where we can, we're also actually investing in these bonds. So ADB invested in the first climate bond in the region. We supported the first sovereign sustainability bond, which was issued by the Thai Ministry of Finance. We also supported the first SOE to issue a social bond in the region, which is the National Housing Authority, earlier this year. So just a really quick fire coverage of the ways in which ADB is preparing to help on transition finance. Thank you.
Thank you very much, Pradeep, for your insights on the energy transition mechanisms. Before we end off today, I would like to invite Keiko, Henry, and Scott to provide some reflections based on the sharing by the various discussants. Keiko, may I start with you, please?
Okay, well, thank you very much. First of all, thank you very much for the wonderful discussions. I learned a lot, and also I have been encouraged the progress, and also new sorts are coming into the Asia. I have 5 takeaways today. First of all, this is finance session. Having said that, we talked about new technological advancement, hydrogen, energy storage, CCUS, carbon storage, and possibly some of the new things coming in, which is great. I think even as a financier or the professional working in the financing side, I think we should kind of keep our eyes on it. By the way, I think ammonia kind of co-filing with the coal might also, I heard, has some impact of the reducing the greenhouse gas emission. Second one, this is interesting. Some people kind of are saying like MDBs are clouding in, but I think this one I also have to kind of raise a little bit of different angle. We in this room we have people from the government as well as people from the private sector and a little bit of MDBs, but when it comes to the energy financing, we always have to think about what kind of tariff we ended up charging based on this energy transition. So, of course, some of the renewable financing and renewable energy provides lower tariff. Having said that, coal still, many countries, still the cheapest way of the financing. So therefore, we have to be very sensible. What's the impact of the tariff? Third, company level of the energy transitions, we definitely should kind of support for the not only the energy company, but also the regular corporates, which some of the manufacturing company have their own power generation facility these days. So therefore, regular corporate finance to the green bond, sustainable bond, although we didn't talk about it, there is a sustainability-linked bond loans, which actually provides the incentive for the corporate to loan more. That's the third point. And a fourth point, this is probably the biggest. I think we really need to think about how to motivate private investors to going in through the risk sharing. But first, I think we have to be very clear what kind of risk existing. Some of the risks are market risks. Some of the risks are government-related risk. Being worked in MDBs, government-related risk, MDBs can step in to support quite a bit, which is a very specific, such as expropriation risk by the government, and also the breach of contract by the government or government-related entities, and also currency incompatibility and transfer restrictions. Those are the things that MDB can work with the government to stop. And also war and civil disturbance, my former agency, MIGA, provide, although that's not a government risk. However, for the market risks, such as foreign exchange risk or interest rate fluctuation risk, is very, very difficult for most of the MDB to cover. So that's why my recommendation is slice the risks and find who can provide the support of this, which risks. I think that's kind of, my point together. Number 5, although you do think MDBs and DFIs are not necessarily working together, amazingly, they also try to work together. Having said that, everybody has a slightly different mandate from their member countries / shareholders. So therefore, one way to look at it is you may not really necessarily like their products are slightly different, but Singapore or even Indonesia, Philippines, China, as the owner of the MDBs, you do not really want to have every single one to have the same products. Therefore, as the market participant, I think I would encourage you to think about how to combine 2 or 3. So therefore, you can reduce your risk significantly. But that's kind of my comments as well as takeaway of today. But I'd just like to thank you, Levin, and everybody. I'm able to learn a lot today. Thank you.
Thank you very much, Keiko. Henry, quick reflections from you, please.
Thanks, Lavan. And so I will echo Keiko's comment about the quality of the insights. I think those are very important, especially since next year for the G20 presidency will actually be Indonesia. So the G20 will actually move towards ASEAN, and as they sort of delivery partner when it comes to the infrastructure agenda, that discussion is very useful because it really sort of, I guess, firm up some of the priorities that we're keen to work with the G20. I think the first one is really to recognize that tension and that trade-off between the social reality, especially on energy transition, and what investors, especially from a developed economy, needs and wants. I think it's fair to say that the tide has changed. I think for maybe too long, the world was happy with greener. We're happy with 10%, 5% reduction in carbon. And I think that tide has changed. And so most investors, especially when it comes to infrastructure, they look at the asset life, they look at 30 years. And I think they're getting very increasingly worried about stranded assets. So if we want in Asia to be able to leverage those investors, I think not necessarily carbon neutrality right away, but I think very clear transition pathways at the government level or sort of big corporates will be required in order to bring that clarity and almost that guarantee that those assets will not get stranded along the way. That I think is very critical. But again, I mean, you probably don't want to sort of go right away into what other countries that don't have a population that grows, that have already the infrastructure are able to do, which is reducing the carbon very quickly. So I think that's one of the key aspects from a government perspective, and from sort of larger corporate and MDBs is really helping governments understand and sort of map those transition pathways. I think then the second point, which is around solutions, what we've seen is that there's actually a lot of solutions out there, especially when it comes to renewables. So I think probably the first lesson was to not reinvent the wheel when it comes to taxonomy, label, etc. Leverage what exists, especially for sectors like renewables where things are moving. I think the key there is really scale and speed. Those things need to happen fast, and I think that's where I think investors not sitting on assets, if they're able to prepare those projects and really sort of recycle them very quickly to other type of investors, and not without the ability to create those projects and sort of move quickly to the next project. I think that's really key. But there's also on the other end still a lot of innovation that's required for energy, but even beyond. I mean, we've talked about circularity and sort of reducing the carbon when it comes to the construction of the infrastructure. I think for those, there's still a need for a lot of innovation, and I think that's where like blended finance and the role of MDBs, such as ADB mentioned, how to transition. But transition away from coal quicker. I mean, those type of financial innovation will still need to be supported by MDBs and governments. The private sector alone will not be able to push the envelope fast enough. So I think there's clearly like two different lessons, like leverage what works, but continue to explore, because in order to get to carbon neutrality, there's more than just renewables. We need to accelerate that transition. That's it. Thank you.
Thank you very much, Henry. And Scott, may I ask for your reflections, please?
Yeah, one of the things that I'm intrigued with here is that there is a lot of cost associated with the transition, especially around the area of stranded assets. And it would appear to me that economic incentives would be a much better approach here than to lean on the MDBs or others to sort of figure out ways to subsidize the transition away. And so, there's a lot of talk today. The United States has embraced the idea of a minimum corporate income tax. And so, as the G20 gathers to look at this issue, the idea of a minimum carbon tax, a global minimum carbon tax, which would allow for a carbon credit trading system, could provide the economic incentives to allow people with stranded assets to have an opportunity to cash in on the reduction in their carbon emissions in a way to monetize them to actually pay for the cost of eliminating the stranded asset. Additionally, it would shift some of the burden away from the developing markets into the developed markets, where countries like the United States, which are in a better position to reduce their emissions because of the technology in our country and the access to renewables, plus things like battery storage, would encourage the United States to actually reduce its carbon emissions and then take some of the burden off of the developing markets to have to transition away from some of the more economically efficient, perhaps dirtier uses of power generation. The other thing that I found intriguing was the conversation that was had around swap lines for accessing US dollar liabilities to be converted back to local currencies. Again, I think this is another place where the G20 could step in and work with the central banks around the world to arrange swap line facilities for a lot of countries where there are not deep enough markets. There are the developed markets like the U.S., the United Kingdom, Canada, Europe, Japan. It's very easy to get a swap currency because they have deep liquid markets, and there are ways for markets to function to provide those swap lines. But where there are markets like Vietnam or Thailand or other countries where you may not have such deep capital markets, the U.S. Central Bank provides swap lines for a number of countries, and perhaps there could be a coordinated effort by the G20 to use their central banks as a means to provide those swap facilities. The last thing is, I think Keiko did an excellent job summing up risk mitigation, much better than I did when I spoke about it. And that is that risk comes in many dimensions, and the need for solutions in risk mitigation go beyond the fact that there's just a high risk equity investment perhaps that to be made, but also to address the issues that Keiko presented. And again, I would encourage the concept of working with the private sector to be able to develop a means to either pool those risks, as would be common in insurance. The pooling of risk is a way to essentially offset one risk against another, or the introduction of cat bond financing. That is insurance or insurance-linked securities, which are very common in the capital markets, where you could actually transfer those risks to institutions who would be prepared to take on the risk because they could assign it a defined risk premium, and then of course run the possibility that if that risk or that event were to happen, then they would face a loss. But if they didn't, they would receive an above market return, just like you would get in junk bonds or in catastrophe bonds that are currently issued by insurance companies around the world. So those three ideas that really came out in my mind about finding ways to resource solutions for some of the problems that I heard brought forth by many of the participants.
Thank you. Thank you very much, Scott, and thank you, Henry and Keiko. Thank you to our discussants today for sharing their insights, which have been very, very useful to help us think through about some of our strategies going forward. Ladies and gentlemen, we have come to the end of the public discussions for the inaugural Asia panel meetings. We hope that everybody found the discussions meaningful. We encourage you to continue the discussions beyond this session. Do reach out to Infrastructure Asia if you would like to connect with any of our discussants today. This is just the start of future conversations and further conversations and connections. If you missed any of our previous discussions, you can continue to catch them online through our virtual platform. With that, I thank you very much for your time this afternoon. My name is Lavan. Thank you for joining us, and please stay safe, everyone.